Hello and welcome everyone to the August 2026 edition of the Market Update by Kingdom Focus Financial. We have today with us Chuck Edsweiler, Michael Smith, and myself, Derek Malden. Take it away.
Thank you, Derek. I appreciate it. And Chuck, it's always good. Thanks for being here. And thanks to
Same here,
all of
gents.
you for tuning in to this month's market update. We've got some really good stuff to go over, some new, fresh perspectives on what's happening. But it's the same old story you've been hearing from us. This year's kind of playing out just like we thought. It may not feel like it, but as we go through today, hopefully you're going to realize that in the big picture, things are actually working the way we thought they would. We're going to talk about some short-term curves, changes that are influencing what you might be hearing or seeing in the media, and then also how it's impacted our portfolios and some of the adjustments that we've recently made in them. So, Chuck, good to have you. Why don't you go ahead and get us started for today?
Thank you, Michael and Derek. Always a pleasure to be with you and certainly our listeners, our clients, investors. So as we're discussing, what are we going to talk about this month? We could easily get into a discussion about what's the Fed going to do, and my goodness, what's going to happen with the election? What about the war in Iran? It seems as though there's chaos amidst all of us in our lives. And how is the equity market continue to be propped up? So if you can see here on the cover slide, we're going to call this particular podcast the four pillars of the continued bull market. And I'm not going to be dismissive of the Fed. Certainly, they control short-term interest rates, which work themselves into the system. It seems as though they're on hold. They went from kind of a easing bias to now, if you will, neutral. But nonetheless, they're on hold. The same thing with the war in Iran. Obviously, we're not experts in military intervention, but we do know a little bit about the investment markets. And the investment markets look out 18 months. And if you look out 18 months from now, January of 2028, you'll see that the price of crude oil futures contract is selling for $68 a barrel. So what the crude oil market and astute traders are saying, this will be resolved. And I think that the markets are taking this in stride. And of course, there's the political whirlwinds, 60 days to 90 days from now. We will see actually November 3rd, our election results. Will the Democrat Party take control of the House and the Senate? Will the Republicans hold on? We don't know, but we know this period will be a little bit of churn, as we call it, and downward chop. But all that being said, it's being propped up, gentlemen, by the four pillars of the continued bull market. So as we take a look here at the next
Hey,
slide,
Chuck,
slide two.
as we
Yeah,
shift
go
to
right ahead, please.
as we shift to that slide, I just want to
Yeah.
give a second for everyone that you just knocked over and put on the floor when you brought up 2028, right? Because I know a lot of you, you're getting ready for back to school right now. Summer's winding
Yeah.
down. We're finishing up those backyard picnics and pool parties, and the kids are getting ready to go back, right, to school. Whoa, we're 2028. We skipped 2027. Well, it's helpful, remember, to keep the long-term purpose and vision in focus. We have to talk about the short-term stuff along the way, but this is where we're seeing things heading. And so that's kind of the point we want to make in this is that, hey, long term's on track. Let's talk about some of the short-term bumps in the road.
Absolutely. So very well said. And I think that slide captures that. If you look at it, folks, and it's very difficult to kind of take yourself out of the day-to-day, which is call it noise that happens. It's very difficult. Hopefully that's a part of what we provide to our investors and clients. The most important metric that determines stock prices are earnings per share growth. Historically, they grow 6 to 7%. Think about stock prices historically grow 6 to 7%. The historic dividend average is 3%. I know today it's at 1. That's how you get your 9 to 10%. You add the dividend yield to earnings growth. So earnings growth is the main component. So what do we look at for this year? You can see here on the slide that the full year expectation is in the 20% range. Right now, it's hovering between 25 to 29%. If I was to go out, Michael, into 2027, not 28, but 27, we're looking at 15%. That gives us a price earnings ratio of 19.6x. which is very reasonable. Back in October of last year, when people were talking about the bubble, the PE ratio was 23. That was high. Historically, bubbles burst like they did in 1902, 1929, 1966, and 2000, which we all lived through. When the PE ratio gets above 25 or so, it was getting close last October. But what happened? Earnings grew faster than stock prices over the last 9 months, and thus you're seeing it as one of the main pillars. If we take a look at the next slide, slide 3, yes, economic growth has not been exceptionally robust. We grew in the first quarter at 2.1%. Now, this is the real GDP growth rate adjusted for inflation. The Q2 number is 1.5, but think about adding back inflation to that number, 3.5 to 1. You get a nominal growth rate of 5%, which is actually fairly decent when you add back inflation. The other metric that we look at is, are people working? And the answer is yes. The unemployment rate remains at a historic low of 4.2%. There's something, as you know, gentlemen, that we follow in our weekly investment committee. It's initial jobless claims. How many people have filed for the first time for a federal unemployment insurance claim check? That's below 200,000, the lowest going back to the 1960s. So the good news is that people are working, their wages are rising. You can see that in the bottom right-hand corner, 3.5% at the rate of inflation or slightly higher. So first pillar is companies are making money, and when they normally do, irrespective of outside events, stock prices rise at that same level. The economy is on firm footing. The most important thing is that people are working and they're actually spending money. So if we get to the next slide here, we can talk about a topic that certainly is being bantered around, not only just in the business and finance world, but certainly in society in general, and that would be inflation. Inflation certainly can be kind of a silent killer, if you will, from a standpoint that when prices continue to rise, if wages don't keep up, people have to pull in or rein in their spending. That means in a society where we have 70% of economic growth coming from retail sales, that it can certainly hinder growth. So what are we seeing here? Well, we're seeing inflation remain, as former Fed Chair Jerome Powell used to say, sticky. It remains higher than what the Fed would like, but it is moderating. It's coming down. If you can see in June, the last print that we had, negative 0.4 was the monthly month-over-month change. So actually we had deflation. It says up there disinflation, which would be 0% inflation, but we actually had negative 1 month. But you go back over the last year over year, it's 3.5%, as I just said in the previous slide. But here's what the Fed does. They look at core. Now, I know people are saying, well, when you strip out food and energy, that's kind of silly. Everyone pulls their energy in their home is derived certainly from power of some sort. We plug in many items and we can't survive without it. We can't survive without food. So why do we pull it out of the number? And the reason is because they're very volatile, number one, but number two, they're not a good predictor of future inflation. So the Fed uses the core number for that reason. That number is at 2.6. That was down from 2.9. Now, the Fed wants to get to 2. The new Fed chair, Kevin Warsh, is adamant about it. So here we sit, yes, higher than the target, 2.6 than 2, but it's coming down. So we see the first 3 pillars: earnings growth, economy on solid footing, inflation moderating. I think the last one, guys, we got 4 and 1 here. So let's talk a little politics, right? Historically, a sitting president's party tends to lose seats in the House and Senate. We have to wait till November 3rd to see what happens. But I think the likely case is here that we don't see a supermajority in the Senate or a vast majority in the House to the Democrat Party, which would put in peril some of the legislative acts of the Trump administration. Now, Whether one defines them as good, bad, or indifferent, that's another story politically. But at least the business community has deemed them to be business friendly. So we'll call it OBA, the One Big Beautiful Bill Act, does allow for very much an incentive on capital expenditures, certainly other parts of it with tax reform. So that likely stays in place. So even though we may see a shift in Congress, we see that remaining. The one on the bottom left, my goodness, we get into next year, gentlemen, year 3 of a president's term historically does very well. You go back to 1945, it's roughly 16%. You go all the way back to 1901, it's close to 18. So it's nearly double the normal set of years. We continue to see reshoring. We continue to see manufacturing base coming back to the U.S. We see the electrification theme. We see investment continue to accelerate. And then what does that do? Well, it says to us, okay, we're going to maintain the portfolio models as is. Now, we may make short-term adjustments along the way, but as we look out, Michael and Derek, to the next 12 to 18 months, I think these 4 pillars setting underneath what is a favorable market to continue to have equities at either their benchmark or slightly above that.
Yeah, and well said. And it reminds me that something we talk about a lot, that we lose sight of in the big picture, Derek, is nobody really notices the 0.5% a month growth,
Right.
right? Because it's so
Yeah.
slow. It's like, did that move? But you get to the end of the year, and if you had that consistent amount, you're now at 6% for the year, and it's like, whoa, where did that come from? And it almost seems like that's sort of the economy we're in. It's not
Absolutely.
growing too fast. It is growing kind of at a steady pace. There's not really a knee-jerk reaction needed for decreases or increases that are out of line. And so we're kind of in this slow growth, steady environment. And we kind of see that continuing as we move forward throughout the next year, is what we're saying. Um, any other
Excellent.
insights, Derek?
Yeah, I would say that one of the things we talked about before is July being historically the highest average return month, and it wasn't the case this past July. So when you look at your statements, you'll see some of that. But that's not necessarily bad for what we're looking ahead to.
Mm,
In fact, we think it's good because there was a broadening out of the market, which means some of
absolutely.
the companies that were really pulling a lot of the growth didn't do as well, but a lot of other companies did. And especially where our portfolios are aligned, some of those companies did really well because we're not always in some of those top companies for different reasons. So just another tidbit to be thinking about as you get your statements and you see those. You can certainly give us a call if you have any questions about that or anything else with your portfolios.
Yeah, we didn't have the high spike that we might see. And the preceding months were also higher than average, and
Right.
it's been that kind of that consistent. I would love it if we could see that in August and September before the midterms. But I'm letting you know that we still think we're going to be pretty volatile over the next 2 months. So maybe enjoy the end of
Great.
summer, enjoy some time with your families, enjoy those last minutes in the pool, and don't look at your online account balances unless you're ready for a potential shocker on one way up or down. Anyway, I hope this was helpful for you. I want to thank you all for tuning in for our update this month. If you like what you heard and you haven't yet, hit our subscribe button. That way you get notifications every time we put a new announcement out. And feel free to share it with your friends. I really appreciate you all. I hope you have a great end as you wrap up summer, and we'll talk to you next time after the Labor Day holiday. Good day.